Well, we are not coming off the best of years for the bond market. Do you expect any fundamental change this year?
Actually, we do, Rhonda. If you think about what happened last year, you would think it was a bloodbath in the bond market, and the broad bond index was down 2%. So in the grand scheme of things, yeah, rates did go up. Yes, the Fed announced that they were going to be tapering. But if you've noticed that since they've actually announced the tapering, it's been very consistent with what happened with the end of QE1, QE2, and Operation Twist, whereas interest rates fell, not rose, and stock prices fell instead of rising. When the Fed is printing money, the history has been that stock prices go up and bond yields go up. And when they're not printing, just the opposite.
So over the past decade, the total return fund that you managed returned 5%, better than its benchmark. What sort of return should investors expect in a fund like yours, a total return bond fund where you're pretty diversified?
Yeah, I think what investors need to do is step back and recalibrate everything. Because we believe, if you look at the data, that we've been in a secular decline in GDP in the United States going back as far as 1960. So in 1960, if you looked at a 3-year trend line, GDP was about 4.5%. If you look at the last 3 years, it's been 2.2%. And it's come down from 3% to 2.5%, down to 2%. And we think that's a secular change in growth, to the point where potential growth gets revised down to around 2% versus where it has been at 3 to 3.5%. And you have to recalibrate the entire capital asset pricing model, what that means for asset allocation, interest rates, and expected returns. So we think we're going to be in a low growth environment, which is going to lead to low asset returns. And you have bonds in your portfolio for income, a little bit of capital appreciation, but really return of principal rather than return on principal.
So is that something more in the area of 2%, 3%, keeping in front of inflation?
I think you can do 3 to 5.
3 to 5,
yeah,
okay.
Because we think rates are going to decline, that 3% is just not a sustainable level of rates given the amount of debt that we have still in the economy and what it means for mortgage rates and housing prices.